Woof. Welcome, Alex.
Thank you. Right on time delivery, right? So,
Just in time delivery.
yes, that's right.
Oh, you made it. Good.
Well, I'm looking out into the audience, and I see everybody's ready for us. Thank you very much. I'm Pat McCarty, and we're going to basically start the next session panel on stablecoins and financial market infrastructure. I'm not going to go through everybody's bios, but I will introduce them as we go through, just to make sure you know who's who. It's pretty simple here. Kristin Boggiano.
Boggiano, it's fine.
Boggiano. Pardon.
I like Boggiano. Or
Chief Legal
variation.
Officer at Alpha Point. And we move on to John Olesky. He's a managing director and co-head of the loan platforms at IHS Markit. And then we're going to move on to Tomasso Mancini-Grifolli, Deputy Division Chief at the Monetary and Capital Markets Department at the IMF. We have as well Tony McLaughlin from Emerging Payments and Business Developments, Treasury and Trade Solutions at Citi. And finally, last but not least, we have with us Alexander Lipton, Chief Technology Officer at Silamoney and Connection Science Fellow at MIT. I hope I got that right, Alex.
Yeah, absolutely. Yeah.
Excellent. Perfect. Really have a great panel here, and I really have to congratulate Chris Brummer on putting together such a fine group of people. All of these people are experts in the field. They're going to give us everything we need to know about stablecoins and possibly on GSCs before the end of the day here. I'd say that it's kind of an interesting thing to have a conversation with so many well-accomplished people, and so we're going to be going through a variety of issues just so people know in advance what will be coming. We're going to try to talk about what stablecoins are and what the subset of them in terms of global stablecoins might be, which the G7 report just talked about. We're going to look at the potential benefits and use cases. We will then talk about the risks associated with GSCs, and then the relevant legal, regulatory, and oversight frameworks, and finish up with the future of GSCs. And just before we start into the questions and comments that we get from our panelists, you have to keep stablecoins in perspective. The digital asset market is very small relative to other markets that we have. There are 3,000 tokens that exist today, and they're actually growing every day. The market cap is about $220 billion, which is really very small relative to most of our established markets. It is growing, however. I would point out, it's an interesting thing. The average daily trading volume in the FX market, as reported by BIS in September, is $6.6 trillion a day. When you look at the digital asset space, we're only talking about $50 to $60 billion a day. Interestingly, Bitcoin is not the most actively traded digital asset. The most actively traded digital asset is a stablecoin, US dollar tether, and it's about $20 billion a day. So that's where the size and shape of this is at the moment, and when we talk about stablecoins, we're going to look at sort of some of the uses and the differences, because it's important to remember, you shouldn't group all stablecoins together. They're not all the same. And based on that, I think we should move on and talk to Kristin about that. Can you give us some ideas to stablecoins, the variety, the shape, and what global stablecoins look like if they're a subset of that?
Sure. It's interesting. So Alpha Point is a technology company that powers exchanges, is the technology behind a lot of the exchanges. And I see a huge demand for stablecoins. And I guess I had to ask myself why, and I know I can get into the taxonomy in a second, but for people in other countries that are looking for stability, the frictionlessness, the ability to take, not have to open up a bank account and try to convert to USD, to just go into Tether, to go and take your local currency, go to an exchange and flip it to something that's more stable is a very attractive feature. So I think that's why there's a significant amount of demand for it. But what are stablecoins? And the taxonomy, and I have experts here that really understand, and there's so many different words we can use. But when I think about it, I think, okay, what is a stablecoin? It's something that's either backed directly or indirectly by another currency, so USD, Euro. Let me stop. Who has purchased a stablecoin in this audience?
Not many.
So, not many, maybe 5. So it's something that's backed by USD or currency, something that's backed by a commodity, so gold or some other real estate. I've seen real estate. Something that theoretically is backed by another cryptocurrency, so something that where a smart contract is, links to another crypto, or theoretically it's something that's backed by an algorithm. It's not backed by anything at all. So stablecoins can vary. I don't know if any of my co-panelists want to talk about the taxonomy, because there are very interesting concepts that are developing.
Yeah, I can have a go. We offer a bit of a taxonomy of stablecoins and other digital forms of money in a recent paper called The Rise of Digital Money, just published at the IMF with Tobias Adrian. I think when it comes to stablecoins, there are various criteria that are relevant. One is the denomination of the coin. So is it denominated in a common unit of account, like the US dollar or the euro? Or is it denominated in its own unit of account? Libra, for instance, is denominated in its own unit of account. Then the question is whether it has a face value. That's an important question. So if it's denominated in the US dollar, does the coin have a face value? If you give $10 to the coin issuer, do you get a coin that says $10 on it? That's fundamental, because then you can ask, is there a redemption pledge? Can you redeem this coin for US dollars at face value? If you can, perhaps that is important to you. That brings greater stability to the coin, as long as the coin is backed fully with $10. So the third element that we look at is, what are the backing assets? What is backing that pledge to redeem into a fiat currency? Ultimately, that makes for a more stable coin. But of course, there are other approaches. Some approaches do not have a face value, and redemption is not at a fixed, pre-agreed value. Redemption is in whatever the going value is of the underlying assets. That's much more similar to what we call investment money. It's almost like holding a share in an investment fund whose value varies over time. A bit more risky to users. So I think stablecoin, the word stablecoin is unfortunate, because it encapsulates so many different types of designs, so many different types of, or levels of riskiness to the user. Riskiness in terms of volatility of the price in a common unit of account. At the end of the day, you want to be able to buy goods with this that are denominated in your domestic unit of account. So again, we offer kind of a tree to think about different designs of stablecoins that has various key criteria that emphasize the very key criteria, such as denomination, redemption pledges, and the nature of the assets backing that redemption pledge.
Thank you, Tomasso. Let's talk a little bit about use cases. Alex, I'm wondering, what type of effective use cases do you find for stablecoins and GSCs out there? And can you give us some ideas on that?
My colleagues and I have been thinking about things like that for quite some time now, and in both more theoretical direction as well as practical direction. At Sila Money, we are actually building a stable coin, which is naturally called Sila, which is aimed at producing regulated payments on the web. And then with my MIT colleagues, we have been thinking about digital trade coin. You might have seen, Libra's white paper, so it's essentially, kind of a variation of what we have written 2 years ago, and very close similarity, if I may put it this way. And the ideas of why you need a stable coin, are simple, right? So essentially, when internet was designed and developed, and by the way, I want to use this opportunity to point out that it was a kind of government project, whatever various fintech and whatever various technical entrepreneurs right now say that only they can develop, through originality and so on. It's simply not true. Internet is an offshoot of a Cold War thinking of creating unbreakable possibilities for communication during the attack by the adversary. So anyway, so when internet was created and eventually indeed developed by the private sector, what was missing there, this protocol of money and identity. If they were there, we would have a completely different world right now. But in fact, there are placeholders, but no actual implementation. So in our mind, stablecoin feels to a large degree the kind of this placeholder for money. Identity is a different story, and a very big one, which needs to be resolved by itself, before we can kind of go any further in this direction. And then, this digital trade coin, which we were designing at MIT, and now kind of starting to implement a variety of variations. That is something which we thought of as a counterbalance to dominant currencies like the dollar, for example, which would be actually outside of purview of any particular central bank and more balanced and so on and so forth. So I do see two directions. One is to complete the internet protocol by providing money on the internet. And the second one is to create an offset to whims and strategies of any one particular central bank. That's how I see it.
Thank you, John. Thank you, Alex. John, can you tell us a little bit about what you're doing with stablecoins in the market loan business that you've got?
Yeah, sure. One thing I want to make sure is not lost is, obviously great writing by Tomasso and Tony. Everyone should read what they've written. It creates a very
100%.
clear,
Really
very clear
interesting.
taxonomy. All of you can take examples that you've seen and say, where does this land? Oh, it's e-money. Oh, it's b-money. Oh, it's i-money, et cetera. Stablecoin, of course, I agree, it's an unfortunate term. I think anything that has the word stable in it makes you feel like someone has to try to make it stable. But maybe risk coin doesn't have the same ring as stablecoin. But from our standpoint, we operate in markets, certainly I do, markets that don't have central counterparties or clearing houses, ones that essentially would not have a delivery versus payment or a DVP-like model like you would have in other asset classes. So we see the opportunity to use a digital representation of fiat to create velocity and ultimately connect the legal transfer of assets with the payments. So essentially creating settlement finality, reducing post-settlement reconciliation, and a lot of those types of things. And certainly, the syndicated loan market has been in the news quite a bit. Some of the speakers coming up later have had some opinions on that. And we see a real opportunity to create something that is modern, is faster, and ultimately has the capability of taking that single dollar, that single unit of account, and use it many times throughout the day, rather than what ultimately happens today, which is if you receive a wire, you're probably not sending it outbound for an outbound obligation. Today, we see velocity, simplicity, and ultimately we have to adhere to the e-money standards that these gentlemen have defined. So you have to be licensed issuer, you have to be able to issue them at par, they have to be fully redeemable by anyone. So all those common things that people would expect. So it is stable, but we generally don't call it stablecoin. We just call it fully collateralized digital representation of cash.
It's long. Fully collateralized digital.
I may have extended it to make it sound more impressive. It's just digital stuff. Let's just.
Digital stuff.
Have you launched this, or is it?
Well,
when do you expect?
Washington is not always super fast like we're used to on the street. So I mean, our expectation is that second quarter of next year we'll launch it as a full capability with obvious extensions into other asset classes. I think the core model of using a smart contract to connect asset transfer workflow with payment is applicable to so many different cases, and we built our platform to accommodate future growth.
Thank you, John. Tomasso, going back to you on this, so you've recently written on digital currencies, and we're shamelessly promoting your paper, which is so good. In fact, John
worth
told
it.
me this before we got up here, said how good it was, so you should read it. One, we'd like to know, since you've been involved in the G7 working group on GSC, what are the main risks that you associate with GSC? What are the big concerns that the international community have about that?
Yeah,
Does everyone know what GSC stands for?
global stablecoins. Global stablecoins. So these are stablecoins that have a global adoption, introduced by a big tech firm, for instance, that already has a very large installed base, but not necessarily. And the risks that we've been writing about at the IMF are multiple. So besides the benefits of stablecoins, we recognize that there are large potential benefits. We also point out very significant risks. These risks are to consumer protection to start with. So remember that stablecoins are backed by assets. They're a private liability of a private firm backed by private assets. So multiple risks. One, that the issuer defaults. And two, of course, related to the assets that back the coin. So market risk, liquidity risk, foreign exchange rate risk. You are exposed to those risks as a user. And the question is whether you understand fully those risks, whether you can get your money back in the case of default of the issuer, whether you really have a legal claim or not against the underlying assets of the stablecoin. Those are important risks to consumer protection. Now, of course, if consumers start to have a doubt as to their ability to redeem, remember we spoke about the importance of redemption in defining stablecoins, there could be a run on stablecoins. And a run on stablecoins could induce large sales of assets and precipitate prices of those assets. That has financial stability implications. Financial stability implications are also related to the disintermediation of the banking sector. You currently hold your money in various instruments, including bank deposits, and that's what you use to make payments. If you start to make payments with stablecoins, you might move your money out of a bank account. That would reduce the funding of banks, certainly the stable and cheap funding of banks, and that could have financial stability implications as well. We believe that banks have means to fight back, of course, and to retain customer deposits by increasing interest rates on deposits and offering better payment services, but there is the potential for a large disintermediation of the banking sector. That's financial stability. We also very briefly speak about integrity risks, so risks to anti-money laundering and countering the financing of terrorism, risks to privacy, risks of creating new monopolies. We have to understand that these providers, these large providers of stablecoins, operate almost like natural monopolies because of the very strong network effects. Right? The fact that you use these coins and makes these coins more useful for me, that's a network effect. And the fact that there are very large sunk costs to developing these platforms makes these new monopolies very hard to regulate. And finally, I'll just raise a risk which was discussed before as a benefit, although countries see it as a major risk, and that is the risk of currency substitution. If you're in a country with high inflation, volatile exchange rates, weak institutions, you might want to hold the dollar more easily through the intermediary of a stablecoin provider. If that's the case, that country loses, if that's the case on a large scale, that country loses its ability to influence monetary policy. That's a problem to the country. It may not be a problem to the citizens of that country, but it's a problem to that country. So lots of risks that come up, some of which can be tackled by existing regulation, some of which will have to be tackled by new regulation, and some of which are just difficult to tackle with regulation, period, like the risk of currency substitution. So we need to think about, as in the international community, think about ways to assuage those risks as well. It's not easy.
Thank you very much. Tony, Citibank has drafted, and it's you, I guess, a number of reports related to digital assets, including an excellent piece on stablecoins.
And great videos on YouTube. So watch Tony.
What's your current thought on some of the regulatory issues that are relevant
Yeah.
for stablecoins, and GSC's our new acronym that we've got?
Yeah, thanks for the question, and thanks, Chris, for the invitation to be here. So I think we have to understand the significance of stablecoins in the cryptocurrency project. And if you like, the cryptocurrency project obviously was kicked off by the Bitcoin white paper, and it's really talking about a world of no issuer, decentralized currencies without, which is censorship resistant. Now, that project has not achieved these cryptocurrencies have not achieved the status of money. They don't fulfill the functions of money. And the significance of stablecoins is simply the idea that if we make these things less volatile, then suddenly they will cross the Rubicon and we will be able to have stable cryptocurrencies that perform the functions of money. So that's the thesis. I think it's a very weak thesis because there are other considerations about whether stablecoins are desirable as a form of money that are prior questions. And the most basic question is this: do we want to return to a world of bearer instruments? Because there's kind of a consensus that bearer instruments are really bad from a financial crime perspective and also pretty inefficient from a processing perspective. So the idea that we want to transition, in order to fix payments, that we want to transition from a world of double entry bookkeeping to a world of tokenization is a fundamentally flawed idea. And I would argue that if we get rid of if we move to a world of stablecoins, if we move the financial system to a tokenized economy, we're soon going to realize the wonders of double entry bookkeeping. So let's examine the assumptions underlying this project. The thesis is this: payments is broken, therefore we need stablecoins. Now, what is it about stablecoins that apparently fixes payments? And here's the thing that it fixes. Payments, you can break down into two layers. In the world of double entry bookkeeping, there's the messaging layer and the settlement layer. And those two things are separate. If I want to make a payment, I send a message to your bank pays you, and then I've got to settle with the bank. So the messaging and the settlement are separate in a world of double entry bookkeeping. In a world of crypto, the messaging and the settlement are together. And the reason why they're together is because it's a bearer instrument. But the benefit of the messaging and settlement being together in a bearer instrument is vastly outweighed by all of the inefficiencies and the risks of bearer instruments. So the fundamental question is this: what kind of financial system do we want? Do we want one based upon double entry bookkeeping, or do we want one based upon tokenization? Just look at the nightmare of crypto custody, the ridiculous lengths that people have to go to custody crypto assets in cold storage. Do we want a financial system that's built upon those types of practices? I think not.
May I add a little bit? I actually agree to a large extent with Tony, but I want to point out that the ultimate bearer instrument is actually hard cash on the nail. And, say what you want, but it is super efficient and possesses a lot of positives, as well as we all know kind of a lot of negatives. So in my mind, at the very least, people should have an ability to use cash in the internet era, which they don't have at the moment for all these reasons which I mentioned earlier. And so, rather than switching the entire payment edifice into kind of stablecoin living on a blockchain, we should try at least, and see what happens if we move large chunks of cash-based payments on the blockchain using stable coins. That doesn't strike me as a particularly kind of controversial way of thinking about it, no?
There's a big difference between cash and a digital asset. There's only so much cash I can stick under my mattress. There's only so much cash I can stuff into a briefcase.
Right.
There's an unlimited amount of digital assets I can put on a USB stick.
Well,
So there's
provided that you have enough to buy it with, right? So this is something
indeed,
which
but-
is unlimited in theory, but not in practice. huh?
Well, if it's unlimited to how much you can buy, then the criminal elements have got quite a lot of purchasing power for these digital assets. So we already see, Bitcoin hasn't made it as a currency, but we already see even multinational entities, multinational companies. I had a multinational client ask me, hey, I've got some trapped cash in Nigeria. I can't get it out because of exchange controls. Can you help me buy Bitcoin so that I can get my money out of Nigeria? It's like, of course not. So this is the crux of the argument. Do we want a financial system based upon better instruments, yes or no? And if we move to this because we're all caught up in this technological, and intellectually stimulating idea about technology which can have a money without an issuer, we're in great danger of misdiagnosing the real problems. And frankly, my final point, payments domestically and internationally can be fixed without resort to cryptocurrencies. And that story, they say, again, the devil has the best tunes. So crypto has all of the airwaves. People are reading about it on the front page. For most of my almost 30 years in payments hasn't been a cool subject. And crypto,
Now it's cool.
crypto has made it cool, and I would like to make payments boring again.
Well, you do work at Citibank.
But-
I mean, let's just point out that he's speaking from a particular perspective. I don't know how much money they get in the payment process and having the two-pointed system.
Very
but
modest.
They probably do
modest.
okay.
Tomasso, you had a point you wanted to make?
Yeah, just a brief point, and that is it's important to understand that there are regulatory standards also for know your customer, so-called KYC, and other standards to enforce financial integrity on providers of stablecoins. So we shouldn't walk away from this thinking that if you use stablecoins, you're necessarily going to be able to operate without any checks, without any controls, and this is an open door to criminal activity. The other thing I'd like to point out is that in the US and the countries where many of us come from, people have bank accounts, and it's perfectly fine to transact from one bank account to the other. Let's just make it more efficient, fine. In many countries around the world, banking penetration is low, of the order of 20% in a lot of countries. The trust in banks is low. And we have to be open to the possibility of new technologies favoring financial inclusion, allowing people who do not have bank accounts to participate in payments, to save safely, and to slowly grow their income over time and their familiarity with payments over time. And we have seen in many countries new technologies, including of the stablecoin type, have a large impact, positive impact on financial inclusion.
The biggest
So I
impact,
think we
sorry,
should
is
keep that in mind
is
as well.
e-money. I'm sorry, the biggest impact, hundreds of millions of customers use Paytm, Alipay, WeChat Pay, M-Pesa, PayPal. The biggest impact on financial inclusion is electronic money, and that is not a bearer instrument.
All right,
Well, but look, if you really go against bearer instrument, let's be absolutely clear, you open society to intrusive controls, which might actually come and haunt you in the end, right? So in reality, the validity or lack thereof of stable coins can only be decided by elected representatives who would enact certain laws and decide what to do, right? So we can go back and forth all the way. Besides, if one were to be pedantic, right, one would point out that the amount of money laundering going through banks is gigantic and way in excess of what can potentially be, kind of laundered through stable coin. Without naming any particular name, shall we say that one prominent for lack of a better word, bank in Scandinavia managed to launder way in excess of $200 billion from one tiny country bordering one bigger country. And, you know, kind of, what would you say about that, right? So they had all controls in the world. And in fact, you know, when I was in banking, kind of very good reputation, like stellar of Scandinavian probity and so on and so forth, while in reality, they ended up laundering, as I said, way in excess of $200 billion.
Well,
so
what I would say is the counterfactual would be if the whole financial system was built on bearer instruments, then the possibilities for that kind of activity would be greatly magnified. And I'll kind of counteract what I said previously, because I've actually got quite a lot of time for Bitcoin and Ethereum. But what I think is that, you know, Bitcoin is to money what Esperanto is to language. Meaning it's an ideological project, and there's a small number of people who really care about Esperanto and a small number of people who really care about Bitcoin, and I would leave them to it. I've got no issue with it. But I don't think we should be running the whole financial system on bearer instruments.
Yeah, no, with that I agree, but I mean, it will never happen in the first place. What I'm saying is that the same way as cash has room in the current environment, stablecoin should be having room in the 21st century. They should be controlled, as Tomasso was saying, you know, clearly, you know, on-ramping and off-ramping should be going on with KYC, AML, and so on and so forth. AML should be enacted throughout the system, but they should exist, huh? Why not?
I think it's clear that most of us don't like money laundering. I think most of us like privacy, and we know that there's a tension between them, and there's also the idea of whether technology can actually help the unbanked and the poor in developing countries. I think we're all in that, we're probably pro almost all of that stuff or anti it, depending upon where we are. But the thing that's important to know is that we write questions to make sure that our panelists have an opportunity to tell us new and innovative things. So I'm going to ask Kristin what she thinks about the U.S. regulatory framework related to stablecoins, which I'm dying to hear because I'm not sure there is one.
No, I don't think there is. I mean, that's for a lawyer, for a regulatory lawyer, this is really one of the most interesting times that you can live in, because there aren't the answers. You have to go back and ask the questions. And, you know, the U.S. Regulatory framework is evolving. I think everybody at the agencies and, you know, are truly really asking the right questions. And you know, I started the digital asset legal group in New York because, you know, as an in-house person trying to answer these questions, we want to get them right, and we truly sit around, and I'm so grateful for my industry peers, and think about, okay, what's the right answer, and you know, we want to get it on the right side. So when I think of a stable coin, I think of, okay, what's it backed by? Is it redeemable 100% by whatever that is? And if it's 100% a currency, I don't believe in it's redeemable in full. It's a security, and if it's 100% backed by a commodity, probably not a security. But then you have to apply the Howey test. Is it being managed by third parties? And are you expecting a profit? Is it not 100% backed by something? And what if it's backed by a crypto? You know, so all of the questions that we've been asking now since, you know, it continue to apply to stable coins and their analysis. And of course, to me, and I was a former derivatives lawyer, you know, if it's not 100% backed, it sounds to me like it's probably a derivative. So, you know. I
agree with that. And actually, kind of the question was meant to illustrate the point that we talked about earlier when we talked about the money trees that are shown by Tomasso in his paper. The details matter in terms of how a particular stable coin would be regulated, and they are not the same. You have some that are private, some that are public. You have some that are fully collateralized. You have some that are not. As was pointed out, you also have some which you have a right to withdraw, and others where you don't. You have algorithms that do things. It's a very, very difficult area, and I kind of wonder what central banks are going to do, Tomasso, in response to this, because it seems as if the name or the when you say it's a stable coin, that's the beginning of sort of the analysis as opposed to the end. It's a very difficult thing, and are you going to basically say we need to draw certain lines here? What's the answer?
I don't think we know exactly what the one answer is. I can throw out some ideas for discussion, and central banks have been thinking increasingly about issuing a central bank digital currency, essentially a liability of the central bank that can be put in the hands of the public directly and that the public can use to transact. And this is similar to your idea of a digital representation of cash. And central banks are thinking about this for a variety of reasons. They differ substantially between central banks. Some central banks are thinking about this to decrease cost of cash management. Others for the stability of the payment system. They're concerned that the payment system, with the decrease of cash, is increasingly in the hands of large private sector players. They believe that that is risky. They see, of course, problems to market contestability, to entry because of this, and they therefore feel like it's their responsibility to enter this market with an alternative solution. Some central banks are thinking about this for financial inclusion purposes, in order to serve the unbanked as cash use diminishes. And there are very active discussions among central bankers about the possibility of introducing CBDC. Some are thinking about this as an alternative to privately issued stablecoins. That argument may or may not work. I think the arguments that I pointed out earlier are sounder. Of course, the question is how to do this. And so there's one model where the central bank would control all the steps of the payment chain, therefore interact directly with us, offer us a wallet with which we can control the digital currency, offer settlement capacity, manage our data, et cetera, all the steps that are involved. Very expensive, very risky for central banks to do this. Most central banks are thinking about establishing some sort of public-private partnership where the public sector would interact and interface with us, customers, would choose the technology and evolve the technology over time. That's where the value added of private companies is. And the central bank would focus on establishing trust. That's what it's good at doing, through regulation and potentially through offering these companies the ability to back their coins in central bank reserves, making those coins very stable, very liquid. So these are different models that central banks are thinking about very actively right now, and it's a very interesting time really to be in a central bank and to be advising central banks about this.
Thank you very much. Now we're going to go to an audience Q&A, and I think we've got people out there with microphones, so if people would like to do that. I guess if you raise your hand, I think we'll have somebody come to you. Before we get to that, I would ask the quick question from our panelist. Jamie Dimon said earlier this week that with respect to Libra, it's a nice idea, but it'll never happen. Do you believe, are you with Jamie Dimon or not? And I'm going to exempt Tomasso because he's with the IMF and doesn't speak to that issue. But Kristin, what do you think? Yes or no?
Bad idea.
Not going to happen. Okay.
For many
John.
reasons.
With Jamie Dimon on that one.
Tony?
Currencies belong to nation states.
I'll take that as a no.
Take it how you will.
Alex?
I think, okay, so I'm partly with and partly against. I don't think it's a nice idea, but I think it will never happen.
I thought it was your idea.
Well, my idea was different because the idea with Libra has enormous hole in it, like the size of Azon Hall over New Zealand. That's the thing. The problem with Libra is that it is an unimmunized issuance of currency. So in developing world where they really claim to help the unbanked and so on and so forth, it will actually generate enormous inflation, right? So the amount of money will automatically double. And then, you know, I'm not a big fan of a quantity theory of money and wrote many times very critically about it. But what is clear, if the amount of money is indeed doubled by a stroke of a pen, the inflation will go up. That's no question about it. And so, you know, the thing is that Libra cannot really substitute for national currency, say in some developing world, just because in order to buy Libra, you will have to use national currency and they will not disappear. They will start to be recirculated and so on and so forth. So, I mean, I think Libra will not happen, and I think Libra is a bad idea. Huh?
That was a no.
Yeah, I think so. Right.
All right, now for the questions.
Double negative,
Yes.
yeah.
Do we have people?
Right.
Right, okay, good.
Yeah.
Go
so
ahead.
my question is around the exchanges where cryptocurrencies are traded. And for the frontier markets, you find a lot of exchanges erupting every day. Then the question comes as to the regulation of such exchanges. Is it something that can be regulated? And what are the issues that we need to, you know, consider in the regulation of such exchanges?
I didn't understand the question.
Who would like to approach that?
Didn't quite understand the question, sorry.
Is the question whether or not all these exchanges should be actively regulated?
Exactly.
I think they will be. I think that's what FATF is for. You know, I deal with many countries at this point, and I'm having active dialogues with many regulators in various countries. They're implementing frameworks so that there's not manipulation on the exchanges, so that there's the proper AML in place, consistent with an international standard that was suggested through FATF.
They'll probably be treated at a higher level than they are today in terms of FinCEN and MSB regulation. To the extent that you're an exchange, a real exchange, I think that you're going to see the standards raised, at least here in the United States. That would be my view. Next.
Yeah, I mean, at the very least for consumer protection, I think it's absolutely required.
Roughly 33 million Americans own some type of crypto. Saw that number within the last month or so.
The IRS is going to be very busy then.
They are. They've been sending out letters. We all know that. Next.
Thanks, Pat. Thank you all for for a very interesting conversation. I'm Linda Jang with Georgetown, and I want to ask a question to Tomasso and Tony. When the Bank of England's Governor Mark Carney announced that the US dollar is too dominant and that central banks should be allowed to issue central bank digital currencies based on a basket of reserves, how is that different from the IMF's special drawing rights, which is also based on basket of 5 reserve currencies? And does the IMF have plans to also issue something based on a digital currency or and convert SDRs into what you guys have been talking about today? And then to Tony, like, I think a lot of what's driving the interest in using some kind of stablecoin is, I think, just everyone's interest in being able to use payments in a very easy way, which means, you know, we should be allowed to transfer payments cross borders in seamless, quick, and a very fashion that we can have full confidence in, which banks have traditionally been able to do, but you require spreads, which we lose a lot of our value. When we transfer money from Europe to the US, we lose money in the spreads. Also, we have to pay fees to the banks in Europe as well as the receiving banks in the US and vice versa. Is there a way for banks to come up with a better payment system that would make our lives easier and make us want to continue banking with you? Thank you.
There was a lot there.
There was a lot there. So Mark Carney's proposal, in short, just so everybody is on board, Mark Carney, in a recent speech that is very much worth reading, says that the predominance of the US dollar induces One, large monetary policy spillovers from the US. Two, high correlations between financial markets. And three, induces a financial cycle driven by US monetary policy around the world. He suggests the introduction of this synthetic hegemonic currency, which is essentially a basket to try to induce financial markets to develop using another currency than just the US dollar. It's a very interesting idea. It's a relatively old idea, going back to Keynes. It's interesting to continue to think about that. Not necessarily to issue a currency in the SDR. The IMF has no plans, let me be clear, to enter this space and issue a currency based on its basket that it uses for accounting purposes only, and that is the SDR.
Mm-hmm. So yeah. I have a response on the question, which is number one on the dominance of the US dollar. The American eagle holds in its hands an olive branch and a clutch of arrows. The greatest olive branch is the US dollar, and the greatest arrow is the US dollar. Don't release them. So that's my view on the US dollar, also related to the Libra question. And the second thing is that, yes, we can fix the payment system without resorting to bearer instruments. I'm talking about this at the IMF tomorrow. If anyone gives me a business card, I'll send you my thesis on this. It's called Fiat Currency 2.0. Yes, payments is broken. We have to bring it into the 21st century, but not by reverting to an old technology before the invention of double entry bookkeeping.
Yeah, if I could add to that as well. You know, I think that's really important. Most of the reason why a lot of us providers are building solutions that use a digital representation of fiat is because the underlying infrastructure is broken. Full stop, it's broken, it doesn't work, it's slow, it's expensive, it doesn't work. Now that being said, as we build solutions, we have to prepare for a future where that may be fixed. So as we plan 2, 3, 5 years out, the $100 billion question is, which approach is gonna win? So from our standpoint, we have to take what's gonna work in the immediate future while also making decisions for Fiat 2.0, crypto, more stablecoins, or ultimately even privately issued coins that are either fully backed or partially backed. Whatever our clients see as fungible as payment, it'll necessitate our adoption, no question.
Very good. I feel sorry for the people up front because they don't have access to the people with microphones. So I'm pointing to this gentleman here in the second row. Please stand up and direct it up here so that
we'll repeat it back.
Respond
if you want.
Very good.
I spent a large part of my career as a compliance director in Europe, and while you were speaking, I looked at the FCA, who is the UK Financial Conduct Authority's views on stablecoins, because I thought it might help. And traditionally, the FCA has led the discussion, given the UK markets are generally more liberal and flexible about use of products. They have said that they believe that it's e-money, stablecoins, and they have already warned in the last three months that anything that contains, that they suspect is unsuitable for retail customers, because particularly if those are having ETFs and those synthetic type products and derivative-based products. I haven't read the full statement, and I read it very quickly, but the one thing I was very surprised they didn't comment about, that the UK regulators have had a long history of using what's called protected terms. So you can't become a bank unless you have a deposit-taking license, and you can't call it. And my experience, having signed off thousands of financial promotions and marketing documents over the years, is they wouldn't really like the word stable and coin coming together, because it does seem a contradiction in terms. So I suspect that most of the European Union, notwithstanding Brexit, will probably go in that direction, because most of the big markets, particularly Germany and France, are generally very anti those types of products when involve retail customers. But I thought it would be worth just mentioning.
Yeah, I think redemption is the key issue there, ultimately. So when you talk about ETFs, investors want to be able to meet redemptions, protect the customer and the consumer.
Next.
I'm Carol Van Cleef, and I would like to, first of all, say that currencies are not sovereign only. In the US alone, going back about 2010-11, we had over 1,000 privately issued currencies in the United States. Now, how many of them were digital? That's another issue. But we have a long history in the United States, and in fact, our sovereign currency is only as old as 1865. So it's an important point. Libra will happen. I'm very bold on that point. It may not happen exactly in the form that it is right now, but it is the future. The players, many of the players at the table have substantial payments experience. They understand the changes that are happening. If you look at Facebook alone, Facebook has been a regulated entity in the payment space for a number of years now, for almost 10 years. Likewise, Uber has its money transmitter licenses. So they're positioned to move forward. Amazon, Google, same situation. Finally, there is regulatory precedent for regulation of stablecoins in the case of where it can be deemed a true currency. The eGold case, E-GOLD, for those of you who are not familiar with it, company was prosecuted in 2008 by the Department of Justice under the goal was to set out rules for this wild, wild west of this thing called digital currencies and they're used for international remittances. It was the first stable coin. It was 100% backed by gold. It was not prosecuted for violations of the securities laws. It was treated as a money service business. And I think it's very important as we move forward, and I know Representative Garcia introduced a bill yesterday, or is in the process of introducing a bill, that would deem all stable coins to be securities. We have to be very careful to preserve the distinction between what's a true currency and what's a security.
Thank you very much. You had the last word. We're in overtime, and I think that the organizers are going to throw us out. So thank you very much, my panelists, for helping us out here. Well done. Yes.